and welcome back to All Things Money. I'm your host for the show, David Blain. Thank you for joining us. Today, we're devoting the majority of the show discussing the advent of a new bear market. The peak in the Dow was back in April the 29th, 2011. And as of yesterday, October the 3rd, 2011, according to the criteria that we use, we officially entered a new bear market within this long-term cyclical bear market. And we're discussing a couple of things that you may want to do depending on your specific goals, your strategic allocation. We're talking about strategic allocation. It's where you look out long-term, 7 to 12 years is what we look for, and looking at the returns that you can expect from various asset classes like stocks, bonds, real estate, things of that nature. And looking out 7 to 12 years, the stock market is actually getting very cheap. And so for people that don't need their money for a while, maybe some good entry points coming up very soon. The bond market, the best predictor of future returns in the bond market is in fact the current yield. And so if you think 2% rate of return for the next 10 years is adequate, then you would purchase U.S. Treasuries because that is about the current yield. Actually, I think it's about 1.8. That is the best predictor of returns going forward. Over long periods of time, if you look at these regression lines of the markets, if you look at some of these ways of determining future returns, they're actually fairly accurate. The problem is in the short term, on a 1-year basis, a 3-year basis, the returns vary widely around this trend line. And so people become very worried about their returns, or if the markets are going straight up, they assume that that trend will also continue well into the future. There's some excellent studies out there that show this. So we feel very confident in looking out and being able to estimate 7 to 12-year returns. The problem is within that time period, you're going to have time periods where it falls well below and well above, and that's where we develop a tactical outlook. So the tactical outlook, as we sit here today, is very negative. So one of the things that you may want to do if you're concerned about the volatility in your portfolio and declines is reduce some of your equity exposure. Now, it's extremely difficult to time the market. Study after study has proven that it's very difficult after taxes and fees to beat the market on a shorter term basis. If you stretch the time frame out, then we do think it is very possible. It's also very difficult. You have to be willing to underperform the market for significant amounts of time on the upside. Now on the downside, that's what we're talking about today, is protecting principal. And so what has been working, government bonds in times of crisis are normally a good safe haven. Currently gold has been doing very well. Some of the speculation maybe has come off of gold, and the past month or two it's actually declined as well. But treasuries have done very well. We see people moving to the U.S. dollar and to the yen, as well as if you really want to hedge exposure, you would invest in something that what we call shorts the market, meaning that as the market goes down, these investments go up. On a simple basis, you could go out and purchase, say, Coke stock, and you would buy it. If it goes up, you make money. You could also what's called sell Coke stock, and this is done through a brokerage firm. Is you don't owe it, you don't own Coke stock, but you go to the brokerage firm where you work, or not work, but where your account is, and you say, I would like to sell Coke, and they say, well, you don't own it. You say, I know, but I would like to borrow some Coke stock to sell. And they say, okay. So they loan you Coke stock, and then you sell it. So you receive, let's say it's trading at $50 a share. So you receive $50 in your account. And the brokerage firm charges what's called margin interest, which is why they're willing to loan you that Coke stock. So now you have $50 in your account, and you owe the brokerage firm 1 share of Coke stock. So if Coke continues to fall, Let's say it falls to $25 a share. You take part of your $50 that you got for selling it, say a month ago, and you go purchase it. So you take 25 of your $50, you purchase the Coke stock, and then you give it back to the brokerage firm to satisfy the share that you borrowed. And so now you're left with $25. That's what's called selling short. As you borrow a share of stock, you sell it in the market, you hold the proceeds. Now, the converse, let's take that $50 Coke stock. So you borrowed the stock, you sold it, and you received $50. If that stock subsequently goes up to $75, you still owe that share of stock to the brokerage firm, and you only have $50. So you need to come up with $25 more. You go and you buy the share of Coke for $75 and you return it to the brokerage firm. So in that case, you lost $25. So selling short is not something that you want to do for, the faint of heart. But used in moderation, let's say you own, $500,000 worth of the market and you're concerned about the declines. Well, you could buy maybe $100,000 worth of something short to help hedge your exposure to the market. Going, 100% short is a very dangerous strategy that we would not recommend. And in fact, unless you really know what you're doing, it can be quite dangerous because your losses are theoretically unlimited. If you bought a share of Coke for $50 and it goes out of business, you've lost $50. If you sell a share of Coke short and it continues to go up, what if it goes up to $1,000 a share? So your losses are theoretically unlimited. So you really have to be careful. But let's say you own let's say you own 10 shares of Coke and you're concerned about the price of Coke, and so maybe you sell 2 shares short, and that will help hedge the decline of Coke. And if Coke goes straight up, well, you can take 2 of your shares that you already own and give them back to the brokerage firm to cover your short. And so if you actually own the stock, it's not quite as dangerous selling it short. Well, that's about all the time we have for today's show. It's my hope that if you join us next week, we'll have some better news about the market. But for now, this week, we're officially in a bear market. So for All Things Money, I'm your host, David Blain, and we hope that you'll join us again next week for some more commentary on the markets.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Interbanks Media.